Sorry about that. You should be able to hear me now. It would help if I unmuted myself. So, anyways, what I was saying is Katie brought up a really interesting question, and I wanted to answer this question before we start the full review because I really want people to think in regards to stop entries. And the question is, when you say there are sellers above or buying below, where exactly do you think they are in the bar? Because when you say that, it's very vague, and I have no idea where to put my limit order. That is the issue with limit order trading. And if you look at anywhere in on the chart, let's take a look at, and I'm going to draw lines here in just a moment. By the way, I'm getting back and forth as far as the sound's good or there's no sound. Can I get a few comments regarding the sound? And I'm going to keep talking while people start commenting. Anyways, with limit orders, one of the challenges with limit orders is, for instance, bar two. There's probably buyers below the low of bar two, but there's also buyers below the low of one. And in general, when you're in a tight trading range, traders will move their limit orders further away. A different example would be when the market is in a strong trend. So let's find an example like right here. Big bear bar on 35 and 34. The first reversal up is probably going to fail. So 36 will probably fail. There's sellers above the bar. But because the momentum down is good for the bears, the market may not go all that far above. Here, this is a reasonable, it's a big bull bar. It's a bigger bull bar. So it may pull back a little bit further. Let me find a better example. And there's probably one over here. Let's just say bar 8 right here, this small doji. There's probably buyers below that bar. And therefore, it's a limit order buy below. And in this case, it almost pulled back 50% of the bar, but there were bulls buying the low of bar 8 and more lower. Verse over here, even let's say 26 right here, there's probably buyers below the 26 low. However, because you are in a trading range day, the buyers may not come in until where my cursor is, all the way down at the 20 low. So I wish I could be more specific with limit order trading, but the reality is limit order trading is very subjective. Most traders should focus on stop orders and swing trading. That's that is one of the things that is misunderstood about what Al tries to explain. And what that is most traders do not understand swing trading well enough. They skip swing trading and they want to go straight into scalping. And it's a really bad mistake. If you do not understand how to swing trade, you will mess up scalping. So if you cannot look at this chart, like if you cannot look at today and you cannot point out where the swing trades are, in other words, always in trading, where do the bulls buy, where do the bulls get out, where do the bears sell, and where do the bears get out? If you cannot point that out on most charts, you have no business thinking about scalping. So if we look at this chart and we think about it from an always in perspective, that is going to be much more helpful. So what I'm going to really focus on over these next couple weeks is really explaining always in and swing trading. And really what that means is understanding how to trade with stop entries. That should be everybody's foundation when it comes to trading. So with that, let's get to drawing a few key levels of support and resistance. As always, first thing I do, I draw the high of the day, and I'll go ahead and draw the low of the day right here. So there's the low of the day, and that's the low of yesterday, obviously. and here is the high of yesterday. Those are likely two key support and resistance levels. And other than that, I'll usually focus on the open of the day once the day progresses. So this is typically how I will have the chart for the most part when the day starts. If your sound is having issues, r- click the refresh button on YouTube, and that may help. Floyd says they got whipsawed today, and they probably got chewed up because they were trading back and forth with stop entries. Now, if you got chewed up with stop entries, why in the world would I recommend trading with stop entries? Because you have to understand the always in direction. And that's what I'm going to talk about. So, really focus when I'm doing this end of day review, really focus on what I'm talking about regarding always in bulls, always in bears. So, bar one, let me get a sip of water here. Bar one is a bull bar, and it closed below its midpoint, but it closed above yesterday's high. That's good for the bulls. Increases the odds that will go a little bit higher, but where is why is there a big tail on the close of one? For the bears, they hope it's a second leg trap or two legs up. Leg one, pull back, leg two, or first leg up to 68, pull back to 77, second leg up to bar one. And then bar two is a bull bar that broke above one and sold off. So what happened there? You had bulls buying during one, disappointed by the sell off at the close of bar one, and a lot of those traders took profits back at the one high. And the bears know that, so the bears sold. For the bulls, it's probably always in long consecutive bull bars, but both bars closing below their midpoints. That is not ideal as far as always in and buying the close. Better to wait. And then bar three broke below two, broke below one, probably buyers below, and probably going to go more sideways. And then bar four, big doji. So now you have an expanding triangle up, three pushes down, probably going to be sideways. Five, we have a bull doji closed above its midpoint, good for the bulls, but it's mostly an inside bar. And there's a lot of overlap with the first five bars of the day, increases the risk of a lot of trading range price action today. And because of the daily chart, I forgot to mention, so let me go ahead and say it real quick. The Bulls they had a strong bull bar right here, and they had okay follow through on the next bar. But this environment is really common to get second leg traps. You're in the middle of a trading range, you have a strong bull bar, and you have a decent follow through bar, but it's not really all that great. It's forcing you to buy right in the middle of the trading range, and it's a possible second leg up. First leg up to here, which is August the 24th, this big outside down bar. We pulled back to August the 25th, and then we got a second leg up right here. And today formed a bear bar. What do the always in bulls do below today's bar? Some might get out, but after a micro channel lasting since August 25th, the second entry buy, down here, I suspect probably buyers below. You'll have some traders who will put a stop, maybe a measured move down of this bar, betting that if the market falls much further than that, we will probably be in a trading range. If we test the close of this bar right here, Monday, or excuse me, if we test the close of Tuesday, it'll probably find support. So you had some traders who sold the close of this bar right at this red line. They sold the close and they were disappointed by yesterday's follow through for the Bulls. So what are they going to do back at the close of this bar? They will probably buy back shorts. So that means the Tuesday's close, the 29th, is likely to be support. Bar 6, we have a bull breakout above all the bars to the left. 3 consecutive bull bars. That's good for the bulls. Probably going to go at least a little bit higher, but we have a tail on 4, tail on 5, tail on 6. So not really all that great. If you buy the close, what do you do if the next bar is a bear bar closing on its low? Unfortunately, you probably exit your trade. Bar 7, bear bar, possible second entry short. First entry was below 2, second entry below 7. Okay to exit longs, and I probably would exit longs here. It's a second failed breakout of yesterday's high. Too much risk of a trading range day. Therefore, probably better to go ahead and get out of longs. 8, we broke below 7 and reversed up, but the bears failed to close below 7. High one buy above 7, probably sellers above and more sideways. It's possible we have to form a wedge with 2, 6, and then a second leg up to on 8 or 9. 9, a little bit of a surprise bar, and you can see what happened with this stop entry. One thing that's important to realize, most stop entries do not fail. What I mean by that is they do not immediately fail. So the bears that sold below 7, they had all of bar 8 to exit the trade, and they had bar 9 to exit the trade. So a lot of traders, had they taken the sell below 7, a lot of traders would scalp out once 8 starts to stall for too long, and they would especially scalp out on 9. And that's in part why this bar reversed up. Bears, they sold. The Bears were disappointed on the next bar. And the Bulls know that. The Bulls aren't dumb. So what are the Bulls going to do once the Bears start to stall for too long? They're going to buy. And that's exactly what happened on 9. 9 is a good bar for the Bulls, always in long, okay swing buy, but the risk for the Bulls is a possible wedge with 1, 6, and one of these highs over here. 10, weak doji bar, but a bad stop entry sell below. So still, you may have some traders buying here, betting on at least a little bit higher. And then 11, we have an outside bar. So what happened? Bulls bought the close of 9. They were disappointed with 10, this doji right here. And they used 11 to either scalp out or sell out of longs for break even or maybe a one tick profit or a small loss. And then 12, we reversed up, closing on its high. The bulls are doing a good job getting bull bars closing on their highs. But the one problem that the bulls have is there's so much overlap with this day. We had a possible, maybe a gap, the 2 close and the 8 close, somewhere in here. But look what happened over here. You had a bull close right here on 6, and then the bears were able to close below 6 on 11. So gaps are closing. And that increases the odds that this is a bull leg in what will become a trading range day. So 12, always in long, okay to be long, but I'd get out below any bear bar at this point. 13, weak doji. So the bulls break out and then they fail. They break to the upside, fail. They're trying to break out to the upside. And arguably, the bulls that bought the 9 close have tried twice on 11, 110, and 13, and they're failing. So for the bulls that bought the 12 close or above 12, they're disappointed with 13. They might get out below 14. 14, weak bull bar. But this looks like a leg in a trading range, and that increases the risk that the market's going to go more sideways. 15, bear bar closing on its low. I think always in bulls exit below 15, and bears will start selling, betting on at least a couple of legs sideways to down. So there's the wedge, and it's really a nested wedge. So leg one, or you can say leg one is the two high, leg two is six, leg three is 14. But the third leg also had a smaller wedge with 11, 13, and 14. 16 follow through bar for the Bears, but closed above the midpoint. So probably sellers above 16. It's a bad high one, and we'll probably get at least a small second leg down. But it's a warning that something is not quite right for the Bears. So bulls get out, Bears go short. Bears okay to be short. And then you can see what happened on 17. Big bear bar, deep pullback. So that's a warning that the bears who sold or were short, they used 17 to buy back shorts. And because of that, it increases the risk that we're going to go mostly sideways. It's possible that we get a measure move down from the 14 high to the 4 low, but probably sellers above 17 and at least a small second leg down. But there's also probably buyers below the midpoint of this bar scaling in lower. 18 bull bar, but after a 4 bar micro channel, probably sellers above. And then 19, we failed to trigger the buy on 18, but 18 is a low one short. And because it's a low one short, there's probably more buyers below 18 scaling in lower. 20, second entry buy. We broke below 17 and reversed up. What about buying above 20 for a swing? You can, but it's a big bar in a small body, and it's pretty much a trading range bar. There's a lot of overlap in here. So this is really not a great buy. This is a pullback in a fairly tight channel, and there's probably more sellers above 20 than buyers. But it's okay to exit shorts and wait for a couple of bars. 21, bad follow through after 20, but probably buyers below 21 scaling in lower. 22, follow through for the Bears. That's good for the Bears. Some bulls who bought the 21 low might exit for a one or two tick loss. Other bulls may stay long, but the bulls that are holding have to be prepared to probably buy more below 20. Surprise bar 23, but possibly three legs down. Down on 17, up on 18, down on 20, up on 21, down on 23, and we may reverse up on 24. And that's exactly what happened. So it's a wedge bottom and a double bottom with 4 and 24. What about buying the close at 24? I would not. The Bulls have yet to make any money above bars in 10 bars, and that's an increase. That increases the risk that we're in a fairly tight bear channel and we may go sideways to down. However, because of 24, the first reversal down below 24 will probably fail. On a smaller time frame, the rally from the low of 24 to the high of 24 is 2 or 3 or 4 consecutive bull trend bars on a 1 minute chart, which means the first reversal down will fail most likely and the bulls will get a second leg up. Some traders might sell the close of 24, but I suspect they'll be pretty quick to get out. Bar 25, big bear bar closing on its low. Outside down bar, even though it didn't trigger the 24, it didn't go above 24. It touched it and turned down, so it's pretty much an outside down bar. What about selling the close at 25? Some traders might, but it's a possible wedge bottom and a double bottom with bar 4. Therefore, there's probably more buyers below than sellers. 25 is a big bar. It's the best looking bear bar in the sell off that began below 14. Better to probably go flat below 24 and not sell. Some bulls will buy, betting that the bears get bad follow through. And that's obviously what happened on 26. 26, second entry buy. Oh, it's an okay swing buy for the bulls, but big tail. There's a tail above 26, and 26 is in the mid, as basically a retest of the midpoint of 25. Increases the odds that the market will go more sideways than straight up. 27, bad follow through or entry bar for the bulls who bought above 26. Low one short below 27, but probably buyers below. And then 28, you can see what happened. Bulls bought the 26 low and they scalped out. And some of the bulls who bought above 26, actually, I misspoke. Bulls who bought below 27 during 28, this current bar, scalped out. The low of 27 is 28 even, and the high of this bar is 31 and a quarter. So the Bulls were able to make 3 points. They bought below 27 and they scalped out 3 points higher. You had Bulls who bought above 26, and their entry price was 53, was 4530.25 was their entry price. And you can see 2 bars later, the market went to 4530.5. And what that means is the market went one tick above the break even bulls. So the bulls, they bought above 26. They were disappointed with 27, and they used 28 to get out, break even at their first entry. 30, bull bar closing on its high. It's a possible start to a swing buy and a test back up to the 18 high. However, it's also a retest of the 24 close and a small second leg trap. We went up on 27, pulled back on 28, and the bulls are getting a second leg up on this bar right here. $30, you can see what happened. The market tested all the way back to the close of bar 28 and then reversed up. So some traders who bought the 29 close were disappointed with 30. And you can see on 31, we broke below 30. The bulls bought and scaled in. And then 32, we got a third leg up. What about buying the close of 32? The problem with that is it's a double top with 24, 25, and it's 3 legs up. The market went up on 27, down on 28, went up on 29, down on 31, and now it's going up again on the 32 close. 33 is a bear bar with a pretty decent tail below the bar. There's probably buyers below, and it's a trading range day, so the bulls are obviously hoping for a bull breakout above a bear flag. We have a bear flag from the low of 26 to the high of 33. They want a bull breakout and a measure move up to 45 to 45.42. But it's a wedge, and you have to respect wedges. Therefore, it's probably okay for the bulls to exit below 33 and to see what we get. 34, surprise, big bear bar, trapping all the bulls to the left who bought anywhere. Big enough bar, we may get a small second leg down, probably always in short. I don't know if we ever became always in long here. So the best sell off, probably the best move of the day was right here. And the reason for it is it was a micro channel for most of the bars. And there was decent bear bars closing below their midpoints. You can argue it's a second leg trap on 34 and it's a test of the 26 double bottom. And that's probably true. You will have some traders who will buy the close at 34, trying to prevent the bears from getting follow through on 35. If the bears do get follow through below 35, that will increase the odds that the market goes lower. 36 consecutive bear bars probably sell the close and always in short. For the bears, they see it as a bear breakout below a triangle. Here's the triangle. Not great shape, but it works. We went down on 4, reversed up, down on 26, reversed up, down on 31, reversed up. And maybe the triangle looks like this. Triangles, really, that doesn't apply to triangles. Any sort of pattern, Al used to always say he thinks of patterns as molted plastic or melted plastic. And what that means is patterns are not going to be textbook. And the way I look at this is this is a contracting trading range. You have a trading range, and it's getting squeezed. It's getting smaller and smaller. And eventually the market's going to break out of the range. And this is the breakout. So strong enough breakout, 34 and 35, probably always in short, and the bears will get at least a small second leg down. 36 bull bar, possible second leg trap. We went down on 26, reversed up, second leg down to 35. But 36 is a small bar with a decent tail above 36, and it's relatively small compared to the downside breakout below 33 down to 35. So probably sellers above and sideways. 37 outside down, good for the bears. Probably going to get at least a small second leg down after 34 and 35. If the bears are lucky, they may get a measured move down based on these two bars. 38, we have a second entry buy and a second failed breakout below the 4 low or the 26 low. However, terrible stop entry increases the odds that there's more sellers above 38 than buyers. 39, bear breakout, probably going lower. 40, really big bar. And look right here. The measured move from the open of 34, close of 35. Measured move down takes you to 15 and a quarter, and the low this bar takes you down to 15 even. So no surprise there. 40 climactic bar at a measured move target and near this higher low. So probably going to start to go sideways. Do you sell the close of 40? I would not. It's climactic in a trading range, and there's an increased risk that traders will take profits. If you do sell the close of 40, it's no different than being short or if you would have sold somewhere up here. So the bears that are short on 40, I would get out above a bull bar closing above its midpoint. 41 inside bar, probably sellers above, but consecutive sell climaxes in a trading range day, I would get out above this bar and I would wait to look to sell again. Now, why would I get out above the bar? Because there's too much risk. This whole thing is a trading range. And if it is a trading range, we could get a very deep pullback. 42, pretty good entry bar relative to 41. Look at the low of 42 compared to the close of 41. The close of 41 is 18 and a quarter, and the low of this bar is 18 even. So the market went one tick below 41 and immediately turned up. That's a sign of strong buying. Consecutive bull bars, probably strong enough for a second leg up. Therefore, I think it might be always in long here, which means the bears have to get out of shorts. Too much risk that we reverse all the way back to the apex of this tight trading range. I'm going to go ahead and draw. Actually, we'll just pretend that 45.30, yesterday's high, is the apex of the range. 43, bear bar, you can call it a high one buy, but it's a pullback and a retest of the 41 high. Some bears, they sold above 41 at 19 even, and they were so disappointed by 42 that they quickly scrambled to put their limit orders to exit at break even on the entire trade, which is the 41 high right here at 20.5. And look right here. The low of this bar is 21. That's actually not right. The high of this bar is 19 even. They were disappointed with 42. So those bears set limit orders at 19 even to get out. And look what happened. The market touched the 19 even. So it touched the 41 high and turned up. That's a sign that you may have trapped bears. Bears giving up on 44. So the bears that sold the close of 40 and scaled in, they got trapped based on these three bars, and they're giving up on this bar. 44, strong enough bull bar, always in long. Okay, probably okay to buy the close and hold for a second leg up. Whenever you're in a trading range and you get a second leg, it's really dangerous to scale in. So if I'm selling closes, most of the time when you're selling closes, especially in a trading range day and it's consecutive sell climaxes, it's usually better to just take whatever you have. In other words, exit the trade above a bar like 41. It's usually better to do that than to look to sell above and scale in. 45 follow through after 44, micro channel since the 40 low, and 4 out of the past 5 bars are strong bull bars closing near their highs. So always in long, probably going to go at least a little bit higher. 46, more follow through buying, getting near the area where traders got trapped. You had bulls who bought the 33 low right here, scaled in lower on 34, and they obviously got trapped during the sell off on 35. And what that means is the low of 33 and the midpoint of 34 is likely to be resistance. Even if it is resistance, this is pretty strong buying pressure, so it's pretty dangerous to sell. But I suspect there will be profit taking around the 33 low in the midpoint of 34. 47, bull bar closing on its high, a little bit climactic. It's kind of a bull breakout of a small channel. We had a breakout on 44, pull back on 45, and we're channeling and we're breaking out above the channel. But that's a minor pattern. You can see it on a 1 minute chart. On a 5 minute chart, it's a breakout of based on several bars, probably going to go higher. However, we may have to pull back first. 48, another bull bar closing on its near its high, pulling back a little bit, getting more overlap, but you can see we're getting close to the 33 low. 49 tested the 33 low and pulled back. What about buying below 49 and scaling in lower? You can, but it's basically a 10 bar or a 9 bar bull micro channel, and that increases the risk of a deep pullback. 50, you can see what happened. You had some traders who bought above 48 at 29.75, and this bar went to 30 even. So the bulls who bought on a stop above 48 were disappointed with 49, and they got out break even on this bar. 51, bull bar closing on its high. It's a high one buy, and in general, high one buys after strong breakouts typically lead to second legs. And in this case, that's probably true, but it's a small second leg trap on a smaller time frame. The market rallied on 41 and 42, pulled back on 43, and it's getting a second leg up to 49. Plus, look where you are in the overall context of the day. Here's the high of the day. Here is the low of the day. So the 48 low is the midpoint of the day's range, and you're pretty much right there. That increases the risk that there's probably sellers and there's market's going to go sideways right here. 52, you can see what happened. There were so many traders trying to sell above 51 that the market went straight down. And that's a sign of strong selling. It's a 4 bar micro channel at this point. You had bulls who bought the 48 close right here, disappointed 49, and disappointed with 50. And look what happened on 51. The close of 48 is 28.75. The close of 51 is 29 even. So the market went one tick above 48 and turned down. 52, strong enough bear bar, probably going to go at least a little bit lower. 53, doji, probably still going to go, I say that, probably going to go at least a little bit lower on 52. 53 is a doji, and you can see what it did. It tested the midpoint of 44. This is a possible 50% pullback of this entire rally. And the bears, there's bears who sold the low of this bar, high of this bar. In other words, there's bears that sold down here around 40 and they scaled in higher. What are they going to do on a pullback here? You know, those bears are going to buy back shorts. 53, I would get out of shorts if I was short. I think the reality is you have bulls buying and scaling in lower. 54, bull bar, probably. There might be sellers above with it being a micro channel since 49. But in general, I don't want to sell above a bull bar like 54, especially when the odds favor a second leg up after the rally up to 48. 55, strong bull bar, trapping the bears that sold above 44. 54, probably going to go at least a little bit higher. And then 56, we broke above 49 and pulled back. So that's good for the bulls. But because of the pullback on this bar, instead of bulls buying into the close, you had traders selling on a pullback. That increases the odds of more sideways trading. 57, inside bar, high one buy, above the bar, possible one bar final flag. I suspect probably sellers above 57 and more sideways. 58, doji, and then 59, outside down. So you can see what happened. You had an inside bar, which is a trading range bar. We broke above it on 58. And then the low of 59 tested the midpoint of the bar. So any of the bears who sold and scaled in were able to make money. And then you had bulls buying below 58. 59, outside up bar, probably sellers above. And it's probably more of a trading range bar than the start of a strong bull, than the start of a strong trend. 60, we triggered the buy above 59 in reverse down. What about buying below 60? The problem with buying below 60 is this is where always in bears, always in bulls will get out. You had bulls buying all the way up, and some of them might get out as 52 started to go lower, or they might get out below 49. But if they did, they probably buy again above 54. Any of the bears that were short, they go long above 54, and they probably get out below 60. And the bears probably sell below 60. 60 is a possible double top with 33, and it's two legs up. We rallied up to 49, pulled back to 53, second leg up to 60. 61, decent entry bar. Some of the bulls that bought below 60 disappointed. 61, they may look to exit break even on the entire tree. Excuse me, let me get a sip of water. The bears the bulls that bought the 60 low right here, they were disappointed on 61, and they may look to get out break even on the entire trade back at the 60 low. And you can see instead the market went straight down. So this is that same logic with down here. Whenever there's a second leg in an overall trading range day, two legs up, two legs down, here leg one, pull back, large second leg down, it's really dangerous to scale in against the move. Rally, pull back, second leg up. It's really dangerous to buy and scale in lower. You're much better off just getting out below a bar when you're disappointed. And this is that reason. 62 looks like bulls are giving up. So 62 is a strong enough bar, probably going to go at least a little bit lower. And then 63, we have a really big bar. 63 still probably sell the close and going lower, but you're getting in that zone where bears got trapped. The high of 41 and the close of 40. So somewhere in here is probably support. 64, small bear bar and pretty much a doji. That's a warning that we're probably going to go sideways here. 65 broke below 64, reversed up. Probably sellers above 65, but there's also probably buyers below 53. So I suspect the bulls that bought below 53 during 63, 64, or 65 will probably make money. 66, inside bar. We might go a little bit lower, but so far, with all the overlapping bars from 64 to 66, I suspect this is a bear leg in a trading range. '67, bull bar, a little bit of a surprise, possible double top with 64. But to me, 67 is enough of a surprise. There's probably buyers on any pullback, so there might be more traders buying the close of 67 than traders selling the close. Some bears they sold above 67, disappointed on the rally up to 60. Excuse me, some bears sold above 66, disappointed by the rally on 67, and they may look to buy back shorts around the 66 high. 68, pulled back, testing near the 66 close and reversed up. Consecutive bull bars, good for the bulls, probably going to go at least a little bit higher. But you can see big tail in 67, tail in 68. The high of 67 is 23.75, and the close of 68 is 23.75. So the bulls are not as strong as they could be. 69, three consecutive bull bars, probably buyers below 69. 70, we trigger the buy and reversed up. It's an outside bar, but outside bars in trading ranges are generally lower probability. So there might be more sellers above 70 than buyers. And then 71, outside down. What about selling the close of 71? I would not. It's forcing you to sell after four consecutive bull bars in a 5 bar micro channel or 4 bar micro channel, really. Probably buyers below 71, and you're getting late in the day. But the sell off down to 66 is strong enough that this may be a small bear flag, and we may get a small second leg and then a leg down. 72, buyers below 71, but a bad high one above 72. Therefore, really not all that great to be long here. 73, we broke above 72 and reversed down. We tested the high of 70. Again, some bulls bought on a stop at 25.5 was their entry, and you can see 25.75, the market went one tick above it and reversed down. So it's allowing all the bulls who bought above any of these bars to get out, break even at their original entry, plus a profit on any scale in. 74, doji, there were buyers below 72, buyers below 73. But again, weak stop entry buy. There might be more sellers above 74 than buyers. 75, strong bull bar, possible bull breakout of the bear flag, low of 66, high of 71. So it's possible we get a measured move up to here, which takes you up to the 60 high, which is right here. But then 76 is bad follow through. So this is a classic second leg trap. We rallied, pulled back for two legs. We broke out to the upside on 75. And it's easy to look at 75 and think, oh my gosh, I've got to get long. This is going to race up to the upside. It's at the end of the day. We're going to get a buy the close rally. Whenever I take buys like 75 in the middle of a lot of trading range price action, especially near resistance, like the midpoint of the sell off, if the market doesn't race up on my entry price, bar 76, I'm going to get out really, really quick. So here, if I was too slow, I'm going to get out below the bar for sure. However, a lot of times, if I buy the close of 75 or above 76 and the market rallies for 30 seconds and starts to stall, or really, if it rallies at all and starts to stall, I'll sometimes just exit and take whatever profit I can get because I don't want to get trapped. And that's why 77 is a big bear bar closing on its low. For the bears, it's a wedge. We went up on 64. Let me just go ahead and draw it and then I'll explain it. There we go. So for the bears, we went up on 64. Remember, it's really common for the start of channels to begin before the end of the prior move. So we had a bear sell off. However, the bull rally began on 64. On a smaller time frame, you'll see a bull breakout here. We pulled back below the bar on 65 and 66. We rallied for a second leg up to 71, pulled back on 72 or 74. And then we got a bull breakout up to 76 right here. But that's a third leg up. So I would get out of longs below this bar. This is enough momentum on 77, makes me think we're going to go lower. So always in bulls, get out below 76, always in bears, sell. And then 77 and 78, the market broke strongly to the downside. For the bears, it's three legs down. We went down on 4 and up. We went down on 40 and up. And then we went down on 78 and up. It's really common. And then we went sideways for the rest of the day. Trading range days are filled with 2 and 3-legged moves. And there's usually a combination of both. So what I mean by that is we sold off to 25 or 26. That's leg one, pulled back, leg two. And they're usually mixed. So this is two legs down right here, but it subdivides into smaller wedges. Here's a wedge, 17, 20, 23, or 25. We have a wedge here, rally to 27, pull back 28, second leg 29, pull back to 31 for the, and then we got a third leg up. So one, two, and then three. We have three legs down. Sell off, pull back, sell off, pull back, third leg. And you can also say one, two, three. And then you can even draw a wedge right here. We rallied up to 37, pulled back, rallied up to 49, pulled back, rallied up to 60. So for me, a general rule that I have is whenever I think it's a third leg in a trading range day, really, whenever I think it's a third leg in almost anything, I'm really resistant to trade in that direction. So what does that mean? A good example is a bar like 12. There's multiple ways to count it. Maybe this is leg one, maybe this is leg two, and maybe this bar nine is leg three. But it's possible the rally to six is leg one. We pulled back, and then the rally to 11 is leg two. We pulled back, and now the rally to 12 or 13 or 14 is leg three. Whenever you're in a trading range, I want to be really careful about entering on third legs. And on top of that, whenever I'm in a trade, whenever I look and I think the market's in a trading range and I think there's a second leg, I want to be very careful about fading the second leg. In other words, I want to be very careful about scaling in to the second leg. So if I'm short, in a strong small pullback bear trend, you can sell and scale in higher. But in situations like this, that's much more difficult. So, and the reason is trading ranges, I've talked about this several times. Trading ranges are often very climactic bars. And what I mean by that, trading ranges are filled with climactic behavior, big bear bars that are far from the moving average, and they force traders to sell near the bottom or buy near the top. It's unsustainable price action. For stop entries, let me just go over always in. I thought the first always in trade, if you're really aggressive, I don't know, maybe this part's kind of confusing. Maybe you sell below 7, but if you do, you probably get out as 9 starts to turn up. As far as buying above 9, it's forcing you to buy high in a trading range, so not ideal. And I thought the first clear always in trade was selling the 15 close. We've had several attempts at a wedge, and there's a lot of bear bars accumulating, and it's probably a wedge top. You can also call it a failed breakout of a bull channel. Anyways, that was reasonable to sell the close at 15. Bears, they can get out above 20, but I don't think they have to. And if they get out below 20, they might sell below 22. But then if you sold below 22 and you see 23, this bear bar right here closing above its midpoint, I'd just be really quick to go ahead and get out because the risk is pretty good that you're going to go higher and you might get a second leg down, but it's already three legs down. Always in bears, always in bulls. They might get out above 24. I would get out of certainly above 26. Bulls can buy above 26 and they get out below 33 or during 34 as it starts to reverse down. Always in short, probably 34, 35 for a second leg. I don't think bears have to get out on 36. For me, I was short right here and I held above 36 and 37. I thought about getting out on 38, but if you remember back to the bar, it was a bull bar closing on its high for a couple of minutes. And then in the final 30 seconds, maybe 40 seconds of the bar, it sold off back to the close. And because it was a weak stop entry buy above 38, I ended up holding above the bar. So I think always in bears can stay short above 38, which is this doji. Always in bears, they can buy back shorts on 40, which is a test of the measured move target, or they can wait and buy back shorts above 41. This bull bar, bulls probably okay to be long, betting on a parabolic wedge. If I am long, which I did buy above 41, taking a chance we would rally back to the moving average. Whenever I take that kind of buy, I want the market to go my way really, really quick. So if I'm buying and my stops below here, if the market is at my entry price for too long, I'm going to get out. And you can see I talked about 42. 42 went maybe a tick below the close of 41 and reversed up. So good follow through, always in long. This part's kind of tricky. I think it's okay to get out below 49 or maybe 2 or 3 points below 49. Maybe you get out on the 52 close. All of that's okay. As far as selling below 52, I think that's a little bit dangerous. The rally up to 49 is so tight, you're probably going to get a second leg up, and you have trapped bears. You have bears who sold down here. They got trapped by the rally, and they're probably going to use any pullback to buy back shorts. 54, always in bulls buy, always in bears get out. And I thought that bulls get out below 60, bears sell. It's 2 or 3 legs up. Leg one, pull back leg two, pull back leg three, or leg one, pull back leg two. Second entry sell, reasonable to get out of longs. Bears can sell below 60. 61 bull bar, 62. Another bear, 61 bull bar, 62 another bear bar. Always in short, probably going lower. And for me, I think it's reasonable to get out anywhere in here. And maybe you get out on below, maybe you get out of shorts after 2 or 3 bull bars. For me, whenever I see a big bar like 67, I'm typically just going to get out on the close because the momentum down is weakening. And I talked about 53. The odds were the bulls who bought the 53 low right here during 63 or 64 were probably going to make money. Some of the bulls bought below 53 during 63 and they scalped out during 64. So to me, the momentum is weak and the context is bad to be short here. We're at the high of 41, which is right where swing bulls bought. The high of this bar is 19 even. If the bulls bought, they would have got filled at 19 and a quarter above the bar. And you can see what happened. The market touched their break even price to the tick and then rallied for a couple of legs. So bears get out anywhere in here. Bulls, they can be long or they can buy a pullback. 75 bull bar closing near its midpoint. Okay to be long. But if you are long and then you see 76, always in bulls get out, always in bears can short, and then always in short below, and you just get out anywhere at this point. Limit orders, lots of limit order trading. Buyers below bars, sellers above bars, all the way up. I thought probably sellers above 17, maybe 18, even sellers above 20, but big tail on 19, big tail on 20. Not really ideal to sell above. Buyers below 21, scaling in lower. Buyers below 24. I thought buyers below 27. Even sellers above 30 or 31. But if you're selling above a bar like 31, it's a little bit dangerous because this is a possible bull breakout of a bear flag. We have a bear flag from the low of 26 to the high of right here, 30, and we may get a measured move up. 33, I think it's reasonable for bulls. Well, let me back up since we're talking about limit orders. So sellers above, I thought sellers above 36 and probably buyers below any of these bars, but you can see it never triggered and it forced traders to chase the market up. Whenever that happens, whenever you get a rally and you cannot buy below bars, that's climactic behavior and it increases the chances of at least a brief pullback, especially when there's a lot of overlap and there's not micro gaps and it's in a trading range. So buyers below scaling in lower. I thought buyers below 58 and That's pretty much it for limit order trading. Maybe buyers below 71, buyers below 73, but probably sellers somewhere above. For buy the close, sell the close, I thought the first clear sell the close was probably 16. I think it's more difficult to sell the close of 17. And here, I thought 32 might be a sell the close bar, but a little bit aggressive. 34, 35, both sell the close. 39 is sell the close. What about 40? I thought 40 was more of a buy the close bar than a sell the close bar. It's the best looking bear bar in the sell off that began around bar 15. And it's at support yesterday's bar 60 low and a measured move from the open of 33 to the close of 34, projecting down. Remember that target was 15 and a quarter, and the low of this bar was 15 even. I thought always in long 42, 43, 44, 45, 46, anywhere in here, but I would get out below probably any bar at that point, and certainly 1 or 2 points below any bar. Always in long, probably 55, 56, but you got to be quick to make decisions here. And then, so let's buy the close in here. Sell the close 61, 62, probably okay. Even sell the close 63, but climactic bar and your near support, probably going to go a little bit lower, but we could easily bounce pretty soon. So, had I sold 63, I'd be pretty quick to get out around the 41 high, especially if we get bad follow through like 64. I did sell the close at 63. I missed the trade selling the close at 62. However, since I sold the close at 63, when I saw the follow through on 64 being a weak doji, I ended up moving my target just to right down here and basically getting, I want to say like 2 points on the trade. And that's a disappointment, mentality. I sold hoping we would collapse below the low, taking a chance. And when the market hesitated, I just took whatever I could get. And then probably sell the close on 77. Let me take a look. Well, first, before I look at questions, let me talk about the daily chart. Daily chart, the bears are setting up a possible second leg trap in a double top with the August 10th high. But tail below today's bar, small bear bar with big bull bars, probably minor reversal, and the first reversal down will fail. But if the bears start to get 2 or 3 consecutive bear bars, traders will be quicker. You will have bears possibly give up. Okay, now let me take a look at some questions. Here's a question about limit order trading. So, Brad, I seem to struggle with profit targets and stops with limit orders. Can you talk about how you think about limit order trading? Where did the market transition from limit to stop order trading? Yeah, it's kind of what I talked about at the first portion of this video. Limit order trading is very subjective. And for me, I'm always viewing things from the context of stop entries. So you heard me talk a lot about always in trading today. And that's exactly what I'm thinking about all day, every day. Always in bulls, always in bears. If you think back to Al's book, I believe it's the trend book, and I've actually got it. I'm going to pull it up because I've got the quote right here. So give me just 1 second. This is a slide. I made a note. That's not exactly what I'm looking for. Give me 1 second. Okay, here it is. So this is at least on the Kindle version of Al's books. This is from page 87 of Al's Trading Price Action Trading Range book. And the quote is, one of the most important skills that a trader can acquire is the ability to reliably determine when a breakout will succeed or fail. And what that means is, if you think about it, breakouts happen on almost every bar. In other words, a stop entry is a breakout. And the only bars that are not breakout bars are inside bars, which means it's typically less than 10 bars on an 81 bar chart. So, in other words, most bars are breakouts. For me, when I look at this chart, I'm always thinking, in regards to your question, Casey, I'm always thinking about the stop order traders. In other words, the always in traders. So, right here, there is no always in directional bias. We're below the moving average and we're going sideways. And I haven't really finished this chart, but it's at least a good enough talking point. Traders will fade everything because there's no clear bias to the chart. Here, the market starts to change. You're starting to get bear bars closing below midpoints, and you're starting to get a micro channel. Here, the context is changing even more. Traders are selling, and because of that, you have a breakout from this high all the way down here, which means any pullback is probably going to be minor and lead to sideways to down trading. Therefore, as far as limit order goes, it's better to be selling and scaling in higher than buying and scaling in lower. So there's a directional bias to the trade. For example, this big bar right here. If you had to pick anything, if you had to pick whether you should buy or sell, obviously you're better off selling. So if you're buying anywhere over here, you have a strong breakout to the downside. If you're buying after the next 5 or 6 bars below bars, it gets to be pretty dangerous. It's kind of like if you're buying during this bear bar, that's a pretty difficult trade. So the first thing I'm doing is I'm always asking myself, what is the always in direction? Is it clearly bullish? Is it clearly bearish like this? Are counter trend traders making money? For me, if I can understand what the stop order traders are doing, then I can understand limit order traders. Remember, a weak stop entry trade is a great limit order trade. So what does that mean? Well, let's take a look right here. This doji right here, that's a weak stop entry short. That's a bad stop entry sell. It's a low one short, big tail, a lot of overlap following a bull bar right here. That's a low one sell. And there's probably buyers below the bar. And because of that, since it's a bad stop entry short, it's a decent limit order buy. Here, this big bear bar right here, that's a terrible limit order buy because it's a reasonable stop entry short. It's a second entry sell following a deep bear breakout. So better to be selling below this bar than buying. So I hope that answers that question. Okay, question. Camden says, "Hi Brad, I was confused listening to the Al in the trading course when discussing risk per trade." So they're saying they were confused when Al was discussing risk per trade. Do you have a set lot size with varying pips or points, or do you have a set risk of 1% on each trade? A lot of traders, the reality is, I think far more traders have a set position size that they trade for that market condition. So what I mean by that is you might be, let's just use one E-mini, or better yet, let's use 10 micros, because 10, you can chop up that number easier. So let's say on an average day, let's say a trader's trading 10 micros. and they'll trade 10 micros for every trade. However, let's say over the next day or two, the range gets much, significantly bigger. So instead of 3 or 4 point bars, let's say we're getting 8 point bars. Obviously, that trader is going to reduce their position in half. You know, the key when Al says most traders should not risk more than 1%, there's a slide where he talks about how most traders should not risk more than 3% in their of total risk on a trade. And what that means is that's 3% from your current stop to the market price, and that includes open profit. Most traders should never risk really more than 1%. And, the longer you trade, the more you experience one gains and being able to read a chart, the more traders will be willing to take a lot of trades to make whatever that goal is. So let's say a trader wants to make 1% per day. And rather than taking one trade, risking 1% to make 1%. So let's say they're trading, I don't know, let's say they're risking 8 points or 6 points to make 6 points, and they're risking, they're trading 10 micros, which is 1% of their account. Instead of doing that, the more experience a trader's gains, a trader might start trading, let's say 2 micros or 3 micros, and they'll start scaling in and taking profits a lot faster. So I think a lot of traders would be much better off looking to trade a default position size. And there's several reasons for that. One is you're never going to have the exact same risk on every trade. You could, I mean, if you're, you could do it with Forex, for example, because you could divide your position by so many different ways. You could trade as far as one unit or one lot in Forex is 100,000 units. You could trade 1,000 units, which is the equivalent of risking a couple of dollars on 10 or 20 pips. So obviously in Forex, you can really divide your position. But your goal as a trader is not to be a risk manager. Your goal as a trader is to trade the chart in front of you. Obviously, you have to have risk management protocols in place, but you can only make so many decisions at one moment. And the more you spend thinking about what position size I need to trade during the trading day, the less time you're going to give yourself to think about what I need to be doing. If you think about it, Ali does a really good job explaining this, but he often thinks about, let's say a flow chart. Let me see if I've got a flow chart on this computer. Give me just 1 second, because I believe I do. Here we go. So think about this decision tree for a second. This is a slide from the encyclopedia webinar that was done back in July. You can find it on this YouTube channel. But, anyways, this is a very basic example of a flow chart, and it's the market cycle. The market's in a trend or a trading range. If it's in a trend, is it in a breakout or a channel? If it's in a breakout, is the breakout strong or weak? If it's in a channel, is the channel broad or tight? And the point I'm making with this is what you have to think about is this is one decision you have to make on every bar. And then there's a second layer. That's a second decision. And then there's a third decision down here. So for me, there's one decision. If, let's say we have a breakout, there's one decision I have to make. There's a second decision I have to make. There's a third decision. I've got to decide if the breakout is strong or weak. And after I decide if the breakout is strong or weak, then I've got to decide, what do I do with that breakout? Your mind has only so much capacity to make so many decisions at one moment. Therefore, if you're making the point with that is you need to have a default for position size. And the reason why you want a default for position size is you want to free up your energy and mental focus to do more things. You have to be able to read a chart during the day and manage orders. So, it's really important to reduce the amount of decisions. Question: when you and Al talk about always in long or always in short, how do you determine that? Is it based on consecutive bars or strength? That is, there's a lot of things that go into context. What you're asking is, how do you read context of a chart? And there's several factors. One is overlap. How much overlap is the market having? Is the market, and really, probably the easiest way to answer that is who's making money on the chart. Remember what I said about stop orders a couple of minutes ago? I'm always thinking about the bulls and the bears. Who's making money? Are bulls making money above bars? Are bears making money below bars? Are limit order bulls making money? Are limit order bears making money? And I've got several examples of that. Let's look through here. You know, even this chart alone right here, it's very clear. Bears are just not making any money below bars. And if bears aren't making any money below bars, that means the market's far above the moving average. And because of that, if the market's far above the moving average, it's going to be really difficult for the market to become always in short. Right here, bears, where are the bulls making money? Pick a place. Maybe the bulls made money here, but that's one moment out of, 20 or 30, maybe 40 bars on a chart. So if bears are clearly holding below the moving average, the market's clearly always in short. What about this chart? Big rally, big sell off. It is mostly always in long here. We're holding above this moving average. That's good, but it's not really all that clear. Let's find a good trading range. Here's a good trading range. What do you notice about this moving average? Here's the blue line, this moving average. We're below the moving average here. We're above the moving average here. We're below it in 5 bars. We stay below it for 4 or 5 bars. We break above it. We go below it. We break above it. We poke below it here. I use the moving average as a quick reference to how many bars are above the moving average or below it. But back to stop orders. I'm always thinking about stop order traders. Bulls buying above 3. Bulls are clearly making money. Bears are not making money below bars. And then finally, bears make money right here. So the market's in a trading range, and the bears do a pretty good job. But then look what happened. Bulls made money above a bar. So a sign of more trading range price action. Bears can't make money, can't make money. And then we break to the upside, and then we get a bear bar closing on its low. So there's many things I could talk about with always in. Here, we have a bear breakout, but the bears failed and the bulls got a reversal. And what do you notice about the rally all the way up here? When did the bears make money below bars? The bears did not make money here. They did not make money here or here. They failed to make money here. They tried to make money right here. And look what happened. It broke to the downside. But even then, it still went sideways. And I don't know if that's helpful or not, but always in is really understanding, what I would focus on is understanding the difference between minor and major reversals. And one thing I'm really hoping to do in the upcoming future is to, and maybe you all could comment on this. I would like to what I'd really like to do is take a series of Al's videos and, spend maybe 20 minutes or 30 minutes talking about each one. So we could do like a live, similar to this, a live stream of it, talk about one of the videos briefly, at least the main key points, and then use a chart to explain it, then answer questions based on it. So in other words, we'll talk about always in video. What are the key things to note about that always in video, and then answer questions. And then we'll take the trend video, the breakout videos, etc. But always in, there's a lot that goes in to major trend reversals and understanding that. But that's probably the single most important thing you can realize, and that is it's pretty much the reversal section in Al's video course. Okay, I'll answer one or two more questions. Is it reasonable to buy the 44 close looking to get to the low of 33? Yeah, I thought that was reasonable. So 33 right here, it's a doji and it's a wedge, 1, 2, 3. But there should be buyers below 33, and the market really should not have done this. And the bulls, they got trapped buying the low of 33, which is basically this blue line, 45.30. So bulls got trapped and the market sold off. And you can see what happened. Bulls bought the 33 low, they bought more above 41. And look what happened. The market raced all the way back to the 33 low. And that's just so common in a trading range day. Question bar 15 looked okay to me, but I can't really figure out why. Can you explain the logic as to why it's a reasonable trade? Well, the first thing is that's good that you look at bar 15 and you see it as a reasonable trade. That's step 1. Step 2 is to really think through the logic. So let's talk about swing traders for a minute. The way I think about it is this. And one of the things that I think really is helpful for everybody to try, always in trading, an extreme version of always in trading is having to be in the market on every bar for the entire day. That's a very extreme always in style of trading. It's not the most effective because obviously if you're trading stop orders when the market is doing this, you're going to get chewed up. But what it does help explain is, let's say you buy anywhere in here. You buy pick a bar, you buy the 5 close, and you have to stay long until there's a reason to get out. So let's play that game for a second. You're long, and then you get a bear bar, second entry short. Do you get out of longs? Yeah, I think it's reasonable to get out of longs. But then look, now you have bar 9. Bar 9 is forcing you to buy at basically the high of the day. So some traders will not be thrilled about buying there, but let's say you did. If you did that, what do you do right here? The point I'm making is it's really hard to stay in this trade. The more difficult it is to stay in the trade, in other words, the less certainty you are that the trade's going to work, the greater the risk of a reversal. So here, the reason why you look at 15 and you think, yeah, it's a reasonable trade is we have selling pressure on bar 3, selling pressure on bar 7, selling pressure on bar 11, another bear bar on bar 15. So we reverse down on 3 and 4. We reverse down on 7 and 8. We reverse down on 11. We reverse down on 15. Compare that to over here. Let's say you buy above 40 or 41. Are you going to exit on 42 if you're trading always in? Of course not. It's a decent entry bar. What about exiting here? No. If you're exiting on this bar, it's a profit maximization bar. What that means is you're exiting because you're trying to exit at the high tick of something. But really, there's no reason to sell. Still no reason to sell. Here, it's a bear bar, but it's following a very tight channel. The reality is the first reversal down is probably going to fail. So that's different. This is much different than this. Why did traders exit right here? So what made 41 a good buy? Because there was, for one, we've been selling off since 15. So 41 minus 15, what is that? That's, well more than 20 bars. And because of that, you had decent buying pressure here, bull bar here, sideways in here, bull bar here. It's consecutive sell climaxes. One, two, maybe three. Double bottom with 60. There's a lot of reasons to buy here. All right, so that's all for today. Tomorrow, there will be another end of day review on YouTube at the same time. So, anyways, you'll get the link just like always. Be on the lookout for it. Tomorrow will be interesting to see what kind of entry bar traders get below this bar. I suspect the bears will be disappointed, but also think the bulls will be disappointed. So if I'm a bull and let's say I bought the close of this bar right here, this is disappointing. And therefore, some traders will probably exit around the close of this bar. So if tomorrow, if we trigger the sell below today's low and then reverse up, that would form a high one, but there might be more sellers above the high one, and we may have to get a small second leg down. The bears are hoping they can get back to the high right here, which is August the 24th. They want to close this breakout point, but they've got a lot of work if they're going to get down there. Since tomorrow's Friday, the weekly chart's important. And look what happened. Big bear bar, small bar, big bear bar, pretty decent reversal, but we're rallying above a decent bear bar from the week of August the 18th. And the reality is there's probably sellers up here. So we have 2 days, we have 1 day left in the trading day. We rallied on last week with the big tail. We broke to the upside. It'll be really interesting to see what kind of tail we get. The bears, they want to damage this bull bar as much as possible. So we'll see. All right. Hope everyone has a good rest of their week. And I will talk to everybody tomorrow.